Hello everyone, I'm Tom with Stock Navigator, and the subject today I'm going to talk about a gaps trading. As you know that gaps trading is one of my favorite trading strategy. It's also one of the difficult strategy to trade as a trader. You can get caught in the wrong direction and start losing money right away. Therefore, understand the gaps, what cause gap, and what to looking for in trading gap is very important. As you know that dozens of stocks they gap up and gap down every day, but not all stocks are tradable. Therefore, only a handful of stocks with a good trade candidate on any given day. Therefore, knowing which one to trade and which one to avoid is a crucial to improving your trading process. So, what are the gaps? Okay, and then I'm going to show you. So, as you know that there are three ways that the price of the stock they can open for trading relative to the prior closing price. It can open higher, lower, or at the same price. So when there is a significant difference between a stock priority, the prior day compared to the opening price, it's called a gap. If the opening price is higher than the prior closing price, it's called a gap up. If the opening price is lower than the prior closing price, then it's called a gap down. When the stock open at the same price as the prior the day before close, or the difference is very small, then it can be considered to be a flat open. So what cause the gap? As you know that variety of factors that can cause the market or for the stock to gap. For example, that the earning report, the breaking news, or the up rate, down rate, or any economic news, or even a simply an imbalance between the supply and demand. It can cause the stock price to be gap up or gap down. Okay, so there are four types of gap. So the first one they call a common gap, and then the breakaway gap, or runaway or continuation gap, and then the last one is they call exhaustion gap. So what is a common gap? As you know that the common gap they refer they happen when the opening price is above or below the previous closing price, but with no trading activity in between. The common gap tend to partial gap and occur on a more frequent basis due to the normal trading activity. So that these gaps are common and usually get filled fairly quickly. The term that they call getting filled means that the price action on a later time, it can be happen few days or a few weeks. Usually they retrade at least to the last day before the gap. This is also known as a closing the gap. So as you can see the chart here, this is so the market they gap up, but and then a couple of days later they will fill up the gap. So this is a common gap. All right, the next one that I'm going to show you is the breakaway gap. So the breakaway gap they occurs when the price gap above the resistance gap or below the support line. Okay, so support or resistance in this case is often associated with a chart pattern such as a trading range, a triangle, wedge, or other pattern. The breakaway gap they occur early in the trend and they show the conviction in the new trend direction. So usually let's look at the chart here. So this price they hold up above the upper trend line here, but when they drop below it with a strong gap down, so they can show you that the new trend is start heading to the other direction. Okay, so that's the breakaway gap. Now let's talk about the next one is called runaway gap. So the runaway gap, typically you've seen it on the chart. They occur when trading activity skips sequential price point. Usually they driven by intent investor of interest. So the market technician they have authorized that runaway gap they often occur at the after security have experienced a breakaway gap. The psychology behind the runaway gap is that the trader who did not get in during the initial move or get tired waiting for the retracement to join what they perceive to be a trending market and jump in and then and follow, try to follow and put up the trend and then continue to push it to direction of the trend. So this one here, if you look at the chart here, so after they run up here and in the middle of the trend, and then they gap up and continue to move higher. Okay, and the next one they call a exhaustion gap. So exhaustion gap, although that happen near the end of a good up or downtrend. So they are many times the first signal of the trend of that move. They are identified by the high volume and the last price difference between the pivot day close and the new opening price. They can easily be mistaken on the runaway gap if one does not notice the exceptional high volume. So it is almost a state of panic if the gap appears during a long down move and persistent that coming up. The selling all position to liquidate holding in the market is not uncommon. The exhaustion gap are quickly filled as the price revert their trend. So likewise, if it happen in the bull move, some bullish overcome trader, and the buyer cannot get enough of that. We don't have enough the buyer from that stock. The price gap up with the huge volume, then there is a great profit taken and the demand for the stock totally rise up and the price drop and a significant change in the trend direction. So exhaustion gap are probably the easiest way to trade and the profit from. So now after that the four type of the gap that I just introduced to you. So this is the key takeaway when you trading gap. So gap are the space on the chart when the price of financial instrument significant change with a little or no trading in between. The gap they can occur unexpectedly at the perceived value of the investment chain due to the underlying fundamental or technical factor. Gaps are classified as the breakaway, exhaustion, common or runaway continuation based on when they occur in the price pattern and what they signal you the new trend direction. The trade must always be in the overall trend direction of the price. So usually you can move to the hour chart and you can see that the price must gap significant above or below the key resistance level on the 60-minute chart, and then you can narrow down, you can see where they gap up or they fill up the gap. The price must retrace to the original resistance level. This will indicate the gap has been filled and the price has returned to the prior resistance and then now become turned to support. There must be a candle signifying a continuation of the price in the direction of the gap. This will help ensure the support will remain intact. So that's why if you know those gap where they happen, and then it depends on you are trade short term or long term, so you can combine a multiple time frame analysis, so you can look at the gap and then looking for the opportunity to trade in that direction of the trend. So now let me show you a couple examples on the gap up trading. This is the Home Depot, for example. So recently Home Depot, as you can see, that they have been sideways for 2 weeks, and then after earning report and then they have a good earning, the price gap up, and then you can see here they gap up with a strong candle and then they continue to move up to the upside. And the next one is like Nvidia. You see that Nvidia in the past they have been gap up one and they continue to push it up in a high demand. They do another gap up here and continue to push it strong in the direction of the trend. And recently, the last 2 days, they also make another gap up and continue to the uptrend. So this is show you that this stock is still very strong and continue to push it up. And another one is, for example, like Qualcomm, QCOM. As you can see here, recently they are now good earning, and then they break out and continue to head north to the direction of the trend. Now let's take a look on the gap down trading like Visa, for example. You can see here the Visa they failed to make a high and then they gap down and they continue to go down, and then they gap down another one. So no reason for you to chase this stock in the downside, because they will continue to go down, as you can see here. The next one is like PayPal. As you can see that PayPal, they hit the high here, and then they fail to make a high, and then they gap down, and then they come back. They try to fill up the gap, okay, and but they couldn't. After they fill the gap, but they couldn't go higher, and then they continue to go down. The trend continue to go down, and then that's why those kind of stock, you see that momentum shift to the downside, and then they just gap down again. So no reason for you to chase out. They don't even have enough momentum to come back to fill the gap. So it means that the downtrend is still in the strong in the downside. Another one is, for example, like Nikola, NKLA. You can see here, after they run up, they shoot it up to the all-time high, and then they fell, they gap down, and then they continue to gap down, and finally they try to come back, but all they can do is just fill up the gap, but they cannot go higher, and then they gap down, and then they come back, they try to fill up the gap, they cannot go higher, and the momentum is still shift to the downside. So even now, there are still no sign to confirm you that the trend is going to change to the upside yet. So as you can see that those kind of example, I want to show you so that you be careful when the stock gap up or gap down, and then in the strong force like this, it's potential they will last for a long time before they be able to turn around and change the direction. So in conclusion, you always trade what you see, not what you think, right? A lot of people, I know that you anxious to try to buy some stock. They have been dropped so hard because you think that the price is so cheap. Or some people that they are in the FOMO mode, they try to chase the stock, they try to chase it when the stock in the all-time high, and then they don't know where is the resistance, and that it can be a big problem for you. So the expert trader course offered by Stock Navigator will teach you the right education to fit your trading objective to be a successful trader or investor. So if you want to understand more how to trade, how to understand the financial analysis, you can watch free webinar following the show more link below. Okay, so again, thank you for watching. If you like what I'm doing for you here, please click the thumb up like button below, or any suggestion you can put down on the comment so I can make in the future a new video for you. Again, thank you for watching. I will see you on the next video. Take care, everyone.